So to me, the collar protects you more to the downside. And if you do a wide collar, it can be just as effective as the covered call, but it gives you more protection to the downside. So with the safeguard strategy, we have implemented two other strategies to make it four instead of two, like the wheel strategy. Can let's use NVIDIA to talk about the safeguard strategy, and that's start by quickly going over the wheel strategy. And so what makes the wheel strategy interesting, and let me get some white space here, is that you have the, I'm just going to call it the cash secured put here. We're just going to say CP, and then we got the covered call. We're going to call it the CC. Okay. And so what happens with the wheel strategy is that you start off by selling a put, a cash secured put. And then if that put is assigned, meaning because if you sell a put, you have the obligation to buy the shares. So if you are assigned the shares, then you do the covered call. And then when you sell the covered call, and if your shares are sold away, because if you sell a call, the obligation you have on the call side is to sell shares to the buyer, right? So your shares are sold away. Then you come back in and you sell a cash secured put again. And so you have the will strategy, right? You just keep repeating it. And whatever happens tells you what happens next. Right? And that's to me the simplicity and the beauty of the will strategy. And that's why it has caught on so amazingly over the years, because it tells someone who is new and conservative regarding options what to do. And you don't have to adjust anything if you don't know how to adjust. Obviously, the will strategy can become a lot more advanced when you're talking about adjusting and you don't want your shares to be called away and things like that once you have the shares. But besides that, it can be very, very pure and simple to just say, I start off by selling the cash secured put at any strike price that I'm okay with owning. Then, if I ever have to take ownership of the shares, I sell a covered call and I have my shares sold away at a price or a strike price that I have the call at some point, and then I just do it all over again, right? I don't have to worry about adjusting. I don't have to worry about anything. That can be the simple part. And so when you're doing a wheel strategy though, you always, you don't have to, but this is what is how it's done. You always start off with with the cash secured put. That is step one. And then you have step two here, which is the covered call. We here at the Dorian Trader have what we believe have made the wheel strategy better, and we call it the safeguard strategy. And we have added two more strategies to it. So right here we have added the, I just put it, I just put the bonnet bull here. We're just going to call it the BB. And then over here we have the collar strategy, and I'm just going to call it the CO. Okay. Now, what makes this better is that the bonnet bull is an improvement of the cash secured put, and in my opinion, the collar is an improvement on the covered call. And so let me break that down so we can all understand. Before we continue with the video, I just want to quickly point out, if you need any additional help, please consider joining our trading club. You can do that by clicking on the link in the description area, and you'll get a 3-month trial for a flat fee of $60. We look forward to seeing you in the trading club. Back to the video. Let's break this down to understand why I'm saying the bonnet bull supersedes or something's better than the cash secured put. So for example, let's just say we were using the video with 44 days to go. And I'm going to do this fast, and please don't interrupt yet, because we're running out of time and I want to kind of explain this, and then I'll leave some time for questions. So just write down your question before you, until I say I'll open it for questions. So anyway, if I was going to, let's just say I love NVIDIA and I wanted to sell it at this 115 strike price, and I'm going to do a cash secured put, and I just say we were going to collect $7. So Within the next 44 days, the most I can make is $7 because it's the cash secured put. The most I can lose is just under $11 at 10 the 10,800, right? So it's basically the just below the 111 strike price. Okay, that's the most I can lose because this $7 acts as a hedge, the 115 minus the 7, right? And then if Nvidia, which it can, if it jumps up more than $7, that's where I don't win anymore. If it jumped up $20, I can only make $7. If it jumped up $30, I can only make $7, right? But if I change this to the bionic bull, then I could decide to take some of that $7 and buy a call. So if I did that here, let's just say I took this $7 and I bought a call. Well, now, because if I'm buying a call, I have unlimited upside for the next 44 days. I'm starting off with 86 deltas. So if I bought 100 shares, I would have 100 deltas. So I'm starting off with 86 of the 100 I would have if I bought 100 shares. But instead of buying 100 shares at the 117 strike price, I'm buying it with a cost basis of one at the 1140, right? So my cost base is, excuse me, it's the 114 strike price is just right here is my cost basis. It's not as nice as selling just the cash secured put, but the cash secured put doesn't give you unlimited upside if you think this thing can potentially rocket up, especially if it's been depressed a little bit. So in this case, you still can own the shares at what you like, and if it jumps up a ton, you have the ability to make a lot to the upside. And for some reason, if you wanted to have that same type of kind of close to that kind of break even of around a 111, well, you can do something like this, and you can do a what we call a modified or custom bionic bull. And in this case, we're still getting $3. Our cost basis is going to be just under the 111 strike price, and we don't have unlimited over the next few days, but we can still make more than 700 if we did this, right? If we went up a little bit more, we can make almost 900 here. We went up a little bit more, and you can see we can make almost 1,000 here by modifying this trade. So to me, doing the bionic bull is it gives you a lot more upside potential and not let the stock run away from you if that's a possibility, if you think that's a possibility, right? And then what makes the collar strategy better than the covered call, in my opinion, is that the covered call, if we did this covered call here, let's just say we sold it at the, let's just do what a lot of people like to do. Let's say we sold it around the 30 delta, okay? We sold this at around the 30 delta. We're going to have the potential to make all the way up to this 130 strike, right? So in this case, if we just did the cover call right away, we have the potential to make about $1,700, just under 17, and our cost basis or the risk that we have is all the way to zero. None of us think the NVIDIA is going to zero, but technically that's what you have, risk all the way to zero. If you wanted to have that call side, have that ability to make that up front and collect 330, then you can do this. But if you wanted to have that ability to make up to that 130, but you didn't want or risk all the way to zero, you can take some of that 300 that you're receiving and you can buy a put. So in this example, let's say we decided we're going to buy the put at the 100 strike. Well, this is what I call a wide collar, right? Well, in this example, you still have a lot of upside, but you don't have risk all the way to zero anymore. Your risk is only 1,500. And some of you understand that that's good based on how much sometimes these stocks can fall, especially when they've been up a lot like NVIDIA was. You guys remember NVIDIA being at like 150 and dropping down to 90. And if you didn't have a collar on it, you felt a lot of pain. And you still have some pain, even though it's not at 190 anymore, it's still significantly down from 150. So to me, the collar protects you more to the downside. And if you do a wide collar, it can be just as effective as the covered call, but it gives you more protection to the downside. So with the safeguard strategy, we have implemented 2 other strategies to make it 4 instead of 2, like the wheel strategy. Can you still use the cash secured put? Yes. Is it still a good time frames to use it? Absolutely. Can you still use the covered call? Absolutely. This morning I was talking to Dr. Christina and I was like, okay, well, on this underlining, it's better to just use the covered call right now. We're bullish on it. We don't think it's going to fall a lot now, and the options are not as robust. Just do the covered call. So it's going to be times when you like that, and others you're just going to do the cover call. It's going to be times you're just going to do the cash secured put. But overall, I think the bionic bull and the collar are better. Okay, so I want you to study this. Go into our video library Go under safeguard strategies, study this process. We all should be doing the safeguard strategy at least with some of our capital, if not the majority of our capital. Okay. Yeah, doing the 0 DT trades, the 1 DT trades, the 7 DT trades, the bread and butter, all of that is fine, but we call it the safeguard strategy for a reason. And as I indicated earlier, with the wheel strategy, you don't have to adjust. You can just do what it says. That's why it's the wheel strategy. Well, with the safeguard strategy is the same kind of concept, right? Whatever you start with is going to tell you what you can do next. And I'm just going to leave it at that and encourage you to go into the video library and check that out. We got like 4 or 5 videos on it, and then come back, ask questions during the live calls.